I want you to think about debt in a way most people never do. Debt is not only a number, debt is a contract written in a currency. And when the currency changes in value, the real meaning of the contract changes with it. That is the part most people miss. They look at the balance on their mortgage and think the number is fixed. They look at the payment and think it is fixed. They look at the dollar amount and think the obligation is the same year after year. But the number is not the whole truth. The purchasing power behind the number is the truth. If you owe $300,000 today and you still owe $300,000 on paper later, but the dollar buys less, then the real burden of the debt has changed. The number may look the same, but the weight of it has become lighter. That is the quiet mechanism at the center of what is happening. The United States has a debt problem. The government owes roughly $39 trillion. That is such a large number that most people cannot feel it anymore. When numbers become too large, the mind turns them into background noise. People hear trillion and move on, but the system does not move on. The interest payments continue. The debt rolls over. The government must refinance old obligations at new rates. The Treasury must keep issuing debt. Investors must keep buying it. The Federal Reserve must decide how much pressure the system can tolerate. And when a country has too much debt, it has only a few possible paths. It can tax more, it can spend less. It can grow faster, it can default, or it can reduce the real value of the debt by making the currency worth less over time. That last path is the one most people do not understand because it does not look like a crisis in the beginning. It looks like normal policy, it looks like rates being managed, it looks like inflation being tolerated. It looks like savers earning less than the rate at which their money is losing purchasing power. It looks like the government paying every dollar it owes while those dollars quietly buy less. This is what is often called financial repression. It is not a dramatic term in practice. It is not a secret button. It is not someone logging into a government account and typing zero. It is a gradual process in which interest rates are held below inflation long enough for the real value of debt to shrink. The borrower benefits, the lender pays. If the borrower is the government benefits. If the lender is the saver, the bondholder, the cash holder, or the person sitting in a low-yield account, that person pays. This is why the same mechanism that can reduce the real burden of government debt can also reduce the real burden of your fixed-rate mortgage. That is the important connection. If you have a long-term fixed-rate mortgage at a low rate, you may own an asset that many people misunderstand. They think the house is the asset and the mortgage is only a liability. That is partly true, but incomplete. A fixed-rate mortgage is also a financial contract. If inflation rises and your income, rents, or asset values rise over time while your mortgage payment stays fixed, the real burden of that mortgage falls. You borrowed dollars when the dollars had more purchasing power. You repay dollars later when those dollars may have less purchasing power. That is not magic. That is how debt behaves under inflation. The bank receives the dollars it was promised. You make the payment. The contract is honored. But the real value of those payments declines over time if inflation is higher than the interest rate you locked in. So the question is not simply, do I have debt? The question is, what kind of debt do I have? What rate is it? What asset does it finance? And what happens to the real value of that debt under the policy environment we are entering? That is how you have to think. Most people were taught that debt is bad, and paying it off early is always responsible. That is too simple. Bad debt is bad. High-interest consumer debt is bad. Variable rate debt that can reset upward and crush your cash flow can be dangerous. Debt used to buy things that depreciate can be destructive, but long-term fixed rate debt used to own a real asset can behave very differently in an inflationary environment. The source example uses the image of a battery, I think. It is useful. Think of the dollar as a battery. The number printed on it is the same, but the charge inside the battery is purchasing power. Inflation drains the charge. The battery looks the same, but it holds less energy. A dollar today and a dollar 10 years from now may have the same name, but not the same power. When you owe money in dollars, inflation drains the purchasing power of the debt too. That is why inflation is an equal opportunity power destroyer. It drains the value of the money in your savings account, but it also drains the value of the money you owe on fixed rate debt. Whether that helps you or hurts you depends on which side of the contract you are on. If you are holding cash at a low interest rate, you are the lender losing power. If you are a borrower with a low fixed rate mortgage, you may be repaying with weaker dollars. This is why the environment matters. If the Federal Reserve holds rates below inflation or allows inflation to run hotter than savers can safely earn, the system quietly transfers wealth away from cash holders and toward debtors and asset owners. That is not a moral statement, it is a mechanical statement. Now let us look at what the government is facing. The United States owes roughly $39 trillion, but the debt itself is only one part of the problem. The more urgent issue is the payment schedule. A huge amount of government debt must roll over. Old debt matures, new debt must be issued. If rates are higher when that debt rolls over, the government's interest cost rises. Imagine your mortgage resetting every year at whatever rate the market demands. If rates are low, you can breathe. If rates are high, your monthly payment explodes. That is similar to what the Treasury faces with large amounts of debt that must be refinanced repeatedly. Interest on the national debt is on track to become one of the fastest growing major line items in the federal budget, not because someone votes for a new program every day. Because the math compounds when debt is large and interest rates are higher, interest expense grows automatically. That creates pressure on the entire system. The government can try to raise taxes, but there are limits. It can try to cut spending, but the largest budget categories are politically difficult to cut. It can try to grow out of the problem. That is ideal, but real growth cannot simply be ordered into existence. So the system searches for the path of least political resistance. That path is often inflation. Plus low real interest rates, the public notices inflation, but not always the full transfer mechanism. The public complains about prices, but many people do not see that the real value of debt is changing at the same time. After World War II, the United States faced a similar debt burden relative to the economy. In 1946, federal debt reached about 106% of GDP. That meant the government owed more than the entire country produced in a year. Many people thought the debt would create disaster, but the United States did not openly default. Over the following decades, the debt-to-GDP ratio fell sharply. By the 1970s, it had dropped dramatically. How? The debt was not simply paid off in full purchasing power terms. The country used a combination of nominal growth, inflation, controlled interest rates, and financial repression. The Treasury paid dollars. Bondholders received dollars. But those dollars lost purchasing power over time. The debt became smaller relative to the economy. The number was managed. The burden was diluted. That is the important lesson. When governments face very large debt burdens, they often prefer to pay back creditors in money that is worth less, rather than openly break the contract. It is politically cleaner. It is slower. It is less visible. It hurts people gradually instead of all at once. That does not mean it is painless. It means the pain is distributed. Savers pay through lost purchasing power. Bondholders pay through negative real returns. Cash holders pay through opportunity cost. People with fixed-rate debt and real assets may benefit. In the 1950s and 1960s, savers who earned less than inflation saw real wealth drain away. Many did not receive a letter explaining the loss. No one called it a tax on their bank statement. Their money simply bought less each year. But a homeowner with a fixed-rate mortgage on a real asset could benefit. The payment stayed fixed, wages and prices rose, the home value could rise, the real burden of the mortgage fell. That is the asymmetry. This is why a low fixed-rate mortgage can become valuable under the right conditions. Suppose someone has a $300,000 mortgage at a rate near 3%. If inflation runs at 3%, 4%, or higher for a sustained period, and if that person's income gradually rises with the economy, then the payment becomes easier in real terms. The payment does not change, but the income side may move. If the person owns a small business, they may raise prices over time. If they are employed, they may receive cost of living adjustments. Even if imperfectly, if they own a rental property, rents may rise. If their home value rises with replacement costs and nominal asset prices, the debt becomes smaller relative to the asset. The mortgage payment becomes a fixed obligation in a world where many other numbers keep rising. That fixedness can be an advantage. This is why automatically accelerating a low fixed rate mortgage may not always be the best decision. Again, this is not true for all debt. If you have a high rate mortgage, a variable rate loan, credit card debt, or debt attached to a weak asset, the logic is different. But if you have a long-term fixed mortgage below the rate of inflation or below what safe alternatives can earn, then paying it off early may mean giving away a valuable position. You are handing the bank stronger dollars today instead of letting future inflation reduce the real weight of the payments. That feels responsible because people were taught that debt repayment is always virtuous. But good principles require context. A principle that ignores environment becomes a rule that can hurt you. In a low inflation, high real rate environment, paying off debt may be very attractive. In a financial repression environment, low fixed rate debt can be an asset like liability. That phrase sounds strange, but it is important. The mortgage is still a liability, you must pay it. But the terms of the liability may work in your favor if inflation and policy erode the real value of what you owe. So the decision should not be emotional, it should be mathematical. What is your mortgage rate? What is inflation? What is your after-tax return on safe assets? What is your liquidity position? What is your job or income stability? What is your age? What is your risk tolerance? What alternative use do you have for extra principal payments? Can you invest the difference prudently? Can you avoid wasting it? If the answer is that you will spend the money foolishly, paying down the mortgage may still be better behaviorally. But if you can allocate capital intelligently, then extra mortgage payments on a very low fixed rate may not be optimal. This is where most people make the wrong comparison. They compare debt to no debt. The real comparison is debt versus the use of capital. If $1 can pay down a 3% fixed mortgage, or that same dollar can remain liquid, earn more. buy productive assets or preserve optionality, then the decision depends on the spread and the risk. This is why the saver is on the other side of the system. Financial repression requires a losing side. You cannot reduce the real value of debt without someone absorbing the reduction. That someone is often the person holding money in low yield savings accounts, CDs, money markets that do not keep up after taxes and inflation, or long duration bonds locked into low yields. The person thinks they are being prudent. They may be prudent in a narrow sense, but prudence that loses purchasing power year after year is not safety. It is slow erosion. Suppose someone holds $180,000 in a large bank savings account earning almost nothing. If inflation is 3%, 4% or more, that person is losing real wealth every year. The bank may take those deposits and lend at much higher rates. The saver receives almost nothing. The institution earns the spread. This is not a conspiracy. It is banking deposits or funding. Banks use funding to create loans and buy assets. The depositor receives a rate, the bank earns a margin. If the depositor accepts a very low rate while inflation is higher, the depositor is funding the system at a negative real return. That is why you must know your savings rate, not in nominal terms, in real terms. If your bank pays 0.01% and inflation runs at 3.3%, then your real return before taxes is deeply negative. You are not preserving capital, you are preserving the number while losing the power. That is the trap. A lot of people who are cautious with money become victims of the safest looking choice. They avoid stocks because stocks move. They avoid real estate because it is complicated. They avoid hard assets because they feel unusual. They avoid debt because they were told all debt is bad. Then they sit in cash while the currency loses power. They avoided volatility, but they did not avoid loss. They only chose a loss that arrives quietly. This is the sentence most people need to understand. The system needs some people to earn less than inflation. If everyone could earn more than inflation safely, the debt burden would not shrink in real terms. The repression mechanism would not work. The government's debt problem would remain heavier. Savers would be protected, but the borrower would not get relief. Financial repression works because not everyone escapes it. Some people will hold the wrong assets, some will stay in cash too long, some will own long-duration bonds at the wrong time, some will pay off cheap debt early, some will mistake old rules for current reality. The old rules came from different environments. In 1985, a savings account could pay meaningful interest. In other periods, mortgage rates were high enough that paying them down was a much better deal. In a world of higher real yields, cash and bonds could be attractive, but the environment changes, principles remain, but tactics must adjust. The principle is to preserve and increase purchasing power. The tactic depends on inflation, rates, asset prices, debt terms, and liquidity. That is why you cannot blindly follow a rule like always pay off your mortgage early. You have to ask whether that rule fits the current machine. Now let us turn this into action. There are 3 practical moves that come directly from the logic. The first move is to pull your amortization schedule. This is not complicated. Your lender will show you the payment schedule. You can see what you owe, how much of each payment goes to interest and principal, and what the balance looks like in future years. Look at year 10, look at year 20, look at the payment. The payment is probably fixed if you have a fixed rate mortgage. Then compare that fixed payment with what you expect your income, rents, or general price levels to be in the future. If your mortgage rate is below 5%, and especially if it is near 3%, do not automatically accelerate payoff without doing the math. Do not send extra principal just because it feels responsible. Do not refinance into a shorter mortgage just because someone told you all debt is bad. Ask whether you are giving up a valuable fixed-rate liability in a world where policy may be designed to erode the real value of debt. Again, this is not advice for everyone. It depends on personal circumstances, but the key is that you must analyze the contract. A low fixed mortgage is not just debt. It is a long-term claim against your future dollars at a fixed nominal price. If future dollars are worth less, the real burden falls. The second move is to compare your savings rate with inflation. Pull your bank statement. Look at the interest line. Do not guess. Look, if you are earning nearly zero, while inflation is running several percent, you are losing purchasing power. If you are earning 4 or 5% in a high-yield savings account while inflation is lower, the situation is different. The point is not to hold no cash. You need cash. Cash provides liquidity. It prevents forced selling. It gives you optionality. It helps you handle emergencies. A person with no cash can be forced into bad decisions at the worst time. But excess cash in a low-yield account is not prudence. It is a subsidy to the banking system. So move idle cash into more competitive accounts, treasury bills, money market funds, or other appropriate short-term instruments. If they fit your risk and liquidity needs, understand FDIC limits. Understand the instrument, understand taxes. But do not leave large sums earning nothing out of inertia. Inertia is expensive. The third move is to understand home equity. If you have equity sitting in your house, you have stored value. But equity inside a house is not the same as liquid capital. It can be useful, but accessing it has trade-offs. There are different tools: a home equity line of credit, a cash-out refinance for some older homeowners, a reverse mortgage. Each one has different costs, risks, and use cases. The point is not to borrow recklessly. The point is not to take on more debt to consume. The point is to understand that in an inflationary environment, fixed rate debt attached to real assets can be powerful, while trapped equity may be unproductive if it cannot be used wisely. But this is dangerous if misunderstood. If you pull equity out of a home and spend it on lifestyle, you have weakened yourself. If you pull equity out and invest it badly, you have increased risk. If you replace a low fixed mortgage with a higher rate loan without understanding the math, you may destroy the advantage. So the principle is not borrow more. The principle is understand the value of your fixed rate debt and your real asset, and do not surrender. Either casually, this distinction matters. Financial leverage can make you wealthy and it can destroy you. The difference is the asset, the rate, the term, the cash flow, and the discipline of the borrower. If you use debt to buy consumption, the system works against you. If you use fixed long-term debt prudently to own real assets that rise with inflation, the system may work for you. That is why the same debt instrument can be good or bad depending on the person using it. Now there are two roads from here. The first road is to keep doing what you were told without updating the context. Accelerate the mortgage even if it is a low fixed rate. Keep large cash balances in a major bank earning almost nothing. Wait for the news to tell you when it is safe. Trust that being conventional is the same as being protected. That road feels comfortable, but comfort is not always safety. The second road is to study the historical playbook and position yourself deliberately. Read about financial repression after World War II. Understand how interest rates were held below inflation. Understand how savers lost purchasing power. Understand how fixed-rate debtors and asset owners benefited. Understand that this can happen without formal default and without anyone announcing that savers are paying the bill. Then look at your own balance sheet. What do you own? What do you owe? Which of your assets can reprice with inflation? Which of your liabilities are fixed? Which parts of your financial life are being drained by inflation? Which parts benefit from inflation? Most people never do this. They think about income, expenses, and account balances, but not balance sheet structure. That is a mistake. In a debt cycle, balance sheet structure matters enormously. If you own cash and no assets, inflation hurts. If you own assets and fixed debt, inflation may help, though not always evenly. If you own variable debt, rising rates may hurt. If you own long bonds at low yields, inflation may hurt. If you own productive businesses with pricing power, inflation may be manageable. If you own real estate with fixed debt and rising rents, inflation may work in your favor. This is the real analysis. It is not about whether debt is good or bad. It is about the relationship between your assets, liabilities, income, and the currency. That is how I think. I do not ask. Is this safe? I ask. Safe under what conditions? Cash is safe if you need liquidity tomorrow. Cash is unsafe if held for 10 years in a negative real rate environment. A mortgage is dangerous if the payment floats upward and your income cannot keep up. A mortgage is valuable if the rate is fixed low and attached to a durable real asset. Bonds are stabilizing in a deflationary shock. Bonds can be destructive in a long inflationary repression cycle. Real estate can protect purchasing power. Real estate can also bankrupt an overleveraged owner. There are no assets that are always good. There are only assets that fit or do not fit an environment and a balance sheet. That is why a person must stop thinking in slogans. Slogans are easy. Systems are true. The current system punishes people who save in a way that does not keep up with inflation. It punishes people on fixed incomes whose costs rise faster than their income. It punishes people who avoid all long-term debt but hold no assets. It punishes people who follow old rules without measuring real returns. It rewards people who own scarce and productive assets, who locked in long-term fixed-rate debt at low rates, who understand purchasing power, and who do not let banks capture the spread on their laziness. That may sound harsh, but systems are not kind or unkind. They are cause and effect. If your cash earns less than inflation, you lose purchasing power. If your mortgage rate is fixed below inflation, the real burden of your debt declines. If your asset rises with inflation, your nominal wealth may increase. If your wages lag inflation, your real income declines. These are not opinions, they are relationships. And once you see the relationships, you must act. The question many people ask is why their banker does not explain this to them. Why does the bank not call and say, your 3% mortgage is valuable. Do not rush to give it back to us? The answer is obvious. The bank is on the other side of the contract. If you owe the bank at 3% and new loans yield much more, your old mortgage is not the bank's favorite asset. If you pay it off early, the bank gets its capital back and can redeploy it at higher rates. That may benefit the bank more than it benefits you. This does not mean the banker is evil. It means incentives exist. The financial system is full of incentives. Banks want cheap deposits and higher yielding loans. Borrowers want low fixed rates and rising incomes. Savers want yield and safety. Governments want to finance deficits without crisis. Central banks want to preserve system stability. Each participant acts according to incentives and constraints. If you do not understand your role, you become the source of someone else's profit that is not personal, it is structural. So here is the practical framework. First, identify your fixed-rate debts, mortgage, student loans, business loans, any long-term fixed obligation. Write down the balance, interest rate, term, monthly payment, tax treatment, and asset connected to the debt. Second, identify your variable rate debts, credit cards, adjustable rate mortgages, lines of credit, floating rate loans. These are different. They can become dangerous if rates rise. Do not confuse them with low fixed-rate debt. Third, identify your cash and cash equivalents, bank accounts, savings accounts, money market accounts, CDs, treasury bills. Write down the yield, tax treatment, liquidity, insurance coverage, and real return after inflation. Fourth, identify your real assets, home, rental property, land, business ownership, commodities, precious metals, infrastructure, like assets, and productive equity exposure. Ask which of these can adjust to inflation. Fifth, identify your income sources, salary, business revenue, rental income, pensions, Social Security, portfolio income. Ask which income sources move with inflation and which are fixed. Then look at the whole picture. You may discover that you are better positioned than you thought. Or you may discover that you are lending to the system at low rates while borrowing nothing and owning few assets that can reprice. That may feel conservative, but it could be fragile under financial repression. Or you may discover the opposite, that you have too much variable debt and too little liquidity. That is also fragile. The goal is balance, not maximum debt, not maximum cash, not maximum speculation, a balance sheet that can survive different futures. This is how serious people think about money. They do not ask whether the next Fed chair will save them. They do not wait for a viral date. They do not assume one policy announcement changes everything overnight. They look at the structure. Debt is high, interest payments are large, rolling debt is costly, inflation reduces real debt burdens. Low fixed rate liabilities become valuable. Low yield cash becomes vulnerable. Hard assets and productive assets can protect purchasing power. That is the structure. Now, one caution is necessary. The source narrative talks about a new Fed chair and specific dates. In real life, leadership transitions, nominations, Senate confirmations, and policy paths are uncertain. No serious investor should build an entire plan around one person or one date. That is not the point. The point is the mechanism. Even if the timeline changes, the debt problem remains. Even if one policy figure changes, the incentives remain. Even if inflation comes in waves rather than a straight line, the relationship between fixed debt and purchasing power remains. You do not need to predict every event. You need to understand the forces. That is how you avoid being controlled by headlines. Headlines are noisy. Balance sheets are quieter. Incentives are quieter still. But over time, incentives win. So if you own a low fixed rate mortgage, understand what you own. If you have cash in a low yield account, understand what you are giving away. If you are paying extra principal without doing the math, pause. If you are taking on new high rate debt because you think all debt will be inflated away, be careful. That is a different game. High rate debt can still crush you. Variable debt can still reset. Bad assets can still fall. Cash flow still matters. The winning side of inflation is not reckless borrowing. It is owning the right assets with the right liabilities at the right terms. There is a major difference. People who hear inflation helps debtors and then borrow aggressively to speculate often destroy themselves. They ignore timing. They ignore liquidity. They ignore rates. They ignore income stability. They ignore the fact that inflation can come with recessions, unemployment, and falling real wages. The system is complex, so the strategy must be disciplined. Let fixed low-rate debt work if it is already in place. Do not surrender it casually. Protect cash from idle erosion. Own assets that can adjust to inflation. Avoid bad debt. Avoid excessive leverage. Avoid concentration. Keep liquidity. Measure everything in purchasing power. That is the real playbook. It is not exciting. It is not a get-rich-quick story. It is balance sheet management in a debt cycle, but it can make an enormous difference. A family that pays off a 3% mortgage early may feel proud. Another family that keeps that mortgage, invests the extra cash prudently, maintains liquidity, and lets inflation reduce the real burden may end up far ahead, but only if they have discipline. If they keep the mortgage and waste the extra cash, they are worse off. That is why financial strategies cannot be separated from behavior. The best mathematical strategy in the hands of an undisciplined person becomes a bad strategy. So know yourself. If debt makes you panic, that matters. If liquidity makes you careless, that matters. If investing makes you chase, that matters. If paying off the mortgage gives you peace and prevents worse mistakes, that may be valuable. But at least understand the cost of that peace. Do not pretend it is always mathematically optimal. The purpose of this analysis is not to tell every person to do the same thing. It is to make you see the hidden relationship between debt, inflation, and purchasing power. Once you see that relationship, you can make a more intelligent decision. The most dangerous person in finance is not the person who is cautious. It is the person who is cautious in the wrong way. Holding cash can be caution. It can also be guaranteed erosion. Paying off debt can be caution. It can also be surrendering a valuable contract. Avoiding all assets can feel safe. It can also leave you exposed to inflation. Listening to old advice can be responsible. It can also be outdated. Every rule must be tested against the current environment. The environment now is shaped by debt, deficits, interest expense, inflation risk, and policy pressure. That means the most important question is this: are you positioned as a saver being drained, or as an asset owner with fixed liabilities being inflated away? That is the divide. It will not feel dramatic every day. No one will knock on your door and tell you that your purchasing power was transferred this month. It will happen through grocery bills, insurance premiums, property values, rent levels, wage adjustments, interest rates, and the real burden of debt, quietly, mechanically, year after year. The people who understand it will not be surprised. The people who do not will wonder why they did everything right and still fell behind. That is what makes financial repression so powerful. It punishes the obedient saver who never studied real returns. It rewards the person who understands balance sheet structure. So pull the amortization schedule. Check your savings yield, review your fixed and variable debts, study your home equity, understand your real assets, measure purchasing power. Then make decisions based on the whole system, not one slogan. The government's debt problem is not going away easily. It will be managed through time, inflation, policy, and the distribution of pain. You do not control that. You control your side of the balance sheet, and in a world where the dollar battery is being drained, your goal is simple. Do not be the person holding all the drained batteries. Own the things that can recharge, own the assets that can adjust. Keep the fixed-rate contracts that work in your favor. Avoid the liabilities that can move against you. And above all, stop confusing the stability of a number with the stability of wealth. A dollar amount can stand still while wealth disappears. A mortgage balance can stand still while the real burden falls. A house can look ordinary while it quietly becomes an inflation hedge. A savings account can look safe while it funds someone else's spread. The system is not hiding this from you because it is impossible to find. It is hiding in plain sight because most people were never taught how to read it. Once you can read it, you are no longer forced to be the person the system uses. You can become the person who understands the system well enough to protect yourself. That is the whole point. Not panic, not outrage, not blind trust. Understanding, because when you understand the mechanism, you do not need to be shocked by the outcome. You can prepare before the outcome becomes obvious to everyone else.